I never can remember what the quorum is, and then it's different for the police pension.
I have it on my
gosh.
notes right here. So
Oh, well, good. You
Right
have a
here,
little
my
cheat sheet. Oh, my gosh. All right. Well, I'd like to then go ahead and call to order the City Employee Pension Fund Board special meeting. And we are in a special meeting because the date had to be changed.
Yes.
And first item on our agenda is minutes of July the 26th. So if I could have a motion to approve and a second, then we'll discuss them.
Move to approve. Second.
All right?
Second.
Okay. I think we had one. We had 2 seconds.
2 seconds.
All right. Councilmember Baxter, second. Now, do you all have any questions or see any corrections that need made? Anything at all? All right, all those in favor of approving, if you'll say aye. Aye. And anyone opposed? All right, that motion passes. Now, we have, starting page 4, we have our first quarter expenses. Erin, do you want to go through that?
Yes, ma'am. Nothing out of the ordinary this time. Our regular expenses for our annuities and our health insurance benefits. Nothing abnormal this month.
Okay. I believe we need a motion to approve that. Is that correct? or
They're just
no?
information.
They're just for information. That's the FYI. And then our third item is ratification of the transfer for payroll for October, and that is on page 5. And are there any questions about that? Could I have a motion to approve it, please?
So moved.
Don't be shy. All right, Councilmember Baxter seconded. Anything else about it? All those in favor, please say aye.
Aye.
Is anyone opposed? All right, that motion passes. And then we do have, for information, 2 funerals. Otis Johnson, a widow of William Johnson, and Violet Bowman, 93 and 91 years old.
Incredible. I noticed that too. It's
How about that? That's really good, isn't it? They were doing something right. Both of them widows, and no benefits are due, so that was for information. And then item 5 is the investment review. So we'll let you take it away.
Sure.
Welcome.
Thank you. I'm sorry that I missed the July meeting. I took my family down to Myrtle Beach to celebrate the summer vacation, and I know Mr. Simpson covered for that particular meeting. So going into the books, I think everyone has a copy. There are a few extra copies on the desk. 2022 has continued to be a challenging year in terms of during the third quarter, we saw the return-seeking portfolio continue that downward slide. In fact, on page 3, the total return for the third quarter decreased by 5.96%, which is translated to about $1.4 million. We underperformed the benchmark by about 35 basis points. The benchmark posted a return of negative 5.61%. And one of the things that we saw within, on page 3, first tab, back that one. Yeah.
The first tab.
Just a good one. So on the liability defeasing portfolio in the upper right-hand corner, with interest rates continuing their upward trajectory, the portfolio declined in value about approximately $275,000 and that is all expected as part of that fixed income strategy. In terms of what we're planning on doing is holding those securities to maturity, and as those securities roll off, they're going to be able to pay off all the projected liabilities for the retirees. So just because there is fluctuation in that market valuation, it doesn't have any long-term consequences on our ability to make sure that retiree benefits are being paid in full. Within the return-seeking portfolio, we continue to actively manage the strategy. We reduce the allocation to cash and increase the allocation to developed international equity, as well as some core fixed income. And then in September, we removed exposure to dedicated mortgages and reduced the allocations to commodities and domestic equities. I believe everyone is receiving our alerts in terms of when we're making those decisions. I think it's being sent to the entire group, or it may just be a couple people, but then it's forwarded by Samantha. So, but in terms of overall, the City Employee Pension Fund, it has a valuation of about $30 million, and just last week we received the actuary report. Within that actuary report, you will see that the amount overfunded has decreased by about 568% to 502%. It was on my notes on there. But in terms of 5 times over your projected benefits is tremendous. You're probably one of the only funds in the entire country in that situation. And because of that, there is a lot of latitude on what we would do with those funds. So those projections are based upon the market valuation as of June 30th. We probably will see a slight decline because of the market valuation as of September 30th. And then there's a couple other changes that occurred in terms of one of the things is the increase in benefits that may or may not have been reflected in the actuary report as of June 30th. It really should be a estimate as of June 30th. So with the projected new benefits of 5% going forward in January, it may or may not have been fully reflected in the actuary report. And then the other thing is that I'm not sure if you're looking forward yet on the cost of living adjustment. I don't think that's a fixed rate percentage, but it's actually inflation driven. Inflation in 2022 has been pretty rampant. So if it is a inflation-tied index on the COLA benefits, that's going to be well in excess of the actuary assessments of just 3%. And we will actually dive into what those numbers look like. So in terms of the return-seeking portfolio, we have the liability defeasing portfolio representing about 27% of the overall pension fund. The fixed income component is about 40%, and then equities represent about 60% in total. Turning to the next page, just kind of as a snapshot for the last 12 months, the return-seeking portfolio declined by 18.35%, or $4.9 million. The liability defeasing portfolio declined by $949,000, but made disbursements in the magnitude of $840,000. The combined portfolio for the last 12 months generated a negative return of 16.2%. It's definitely not what a lot of people expected at the beginning of 2022, but there have been continued pressures coming from the pandemic. So that's the state of the economy, and we kind of go into more of the economic details as we continue to flip through.
Before we go any further,
Go ahead. Is this pretty consistent, like with what you're seeing in other,
Yes.
this amount of change?
Yes.
Okay, I
Yes.
just wanted to make sure that we weren't.
Yeah. So in terms of like how you can measure it, in terms of, yes, these are numbers, but it's relative to the benchmarks.
Okay.
So in terms of the benchmark return was 17.76%. So we did underperform. We're working on that, but in terms of these are consistent with broader indices. And if we want to turn quickly to answer your question, slide number, page 12, right past here. So in terms of the S&P 500 index declined by 23.9%. So if we were fully invested in equities, in domestic equities, we would have been down nearly 24%. So relative to what you're saying. It's like, okay, it's a little bit better. And you can also say, it's like, okay, let's look on the next page, on page 12. Was there a better place to invest your funds? So this particular index up top shows North America. Dow Jones Industrial Average was down 19.7% year to date. Where we could look at one-year numbers, like one-year numbers, Dow Jones Industrial Average was down 13.4%. That only consists of 30 companies, and commodities, that's like make up a significant portion of it. S&P was down 15.5%. The NASDAQ was down 26%. Going into Europe, European Union was down 28%. United Kingdom was down 16.7%. Germany was down 32.8%. There was basically no place to hide.
Yeah.
And in terms of, it's like anywhere you invested, it's like you're probably losing money. The only safe place and safe harbor was energy.
Brazil.
Yeah, Brazil. Yeah, you have Brazil there. It's like, one situation, yes, and you got a whole whopping 0% return. So,
Hey, there's something to say.
So, yes, and I know Aaron had a question. Aaron, I was not able to be at the police and fire pension on Wednesday. Did it look similar?
Yeah, it's actually very comparable to what we're seeing here. My question actually has to do with the actively managed, and we still underperformed the benchmark. And I'm just wondering what are really the driving factors to that?
mainly in terms of if you want to go directly to the...
Sure.
So,
and if I'm jumping ahead,
No.
we can just get there.
No. In terms of, I would rather be responsive to your
Sure.
questions as opposed to kind of jumping in, like,
Okay.
providing a lot of details. So, on page 28, so, under tab 3, and then, and then 2 more slides for
Page 28, you said.
Yep. Under tab 20. So we've made, like in terms of, as you probably have seen, some of our tactical shifts. We moved some money over to cash. By doing so, that helped the portfolio. However, as you kind of go through several of the performance of the individual managers relative to their desired benchmarks, there's underperformance. So it is a manager selection kind of causing the underperformance as opposed to tactical asset allocations and so forth. In terms of just sort of some notable examples where it's like Chaplin, for example, declined by 26.3%. Their respective benchmark was supposed to be 15.2%. Going down, WCM, Focused Growth International, it's in the international section. You would see it's like their return was negative 32% versus negative 25%. All these represent small percentages, but in terms of when we're talking about 59 basis points of underperformance, these type of gaps generally don't help at all.
So it looks like a couple of these, Aristotle, Russell 3000, the 91, MSCI, excuse me. Some of these we've brought on super recently, and unfortunately they don't have a number of years worth of data to help them out, pull them out of that. But did those allocations come from other managers that
Yes,
that have done a little bit better? Maybe. Unfortunately, we zigged maybe when we should have zagged, or I mean, there's no way to know, obviously. But is that how that happens? Those funds come from a reallocation of what we have. We diversify a little bit more, and then unfortunately, they just have a 1 year. They just have 1 year to.
They have no history with us.
But some of them go back a few years. So in terms of, it's like Aristotle goes back, this inception column shows how long we've held them. So for that particular manager, it's like going back to June of 2018. So that allows you to at least have the 3-year performance numbers. And you can see over 3 years, they outperformed.
The international.
Right, in the international.
Okay, I'm sorry. I was looking at the Atlantic one.
Okay.
Yeah.
I guess, David, this makes me think about a lot of the discussion that some of the financial experts are having about the next year.
Yes.
And, I mean, I have no idea, but this could look a whole lot worse depending on what happens with our economy. So do we need to think about doing something different or making some changes?
Can we just put some money somewhere until it gets
Well,
better?
put it in your savings account. It won't earn anything, but it won't drop either.
So I would suspect that we're invested based on the allocation that the board set at
Yes.
some point in time. If that is something that we want to look at, my question would be, obviously, our liability diffusing side is fine. It's going to be fine.
Right.
It's doing what it's intended to do.
Right.
The return-seeking portion, what is our trajectory? Are we on a 20-year? Are we on a 30-year? What is the time frame that we're looking at? Are we going to have time to recover if we don't adjust currently?
Like in terms of, for the current beneficiaries,
Yeah.
we're probably never going to touch the return-seeking portfolio.
Sure.
So this is,
Right.
and in terms of like, this is one of those like challenging questions when you kind of like talk about generational wealth. So on a personal level, if you are like an older individual and you know that you're going to have a sizable inheritance, how do you feel most comfortable having those funds invested? So in terms of this is it's like it hits personally because it's like my parents, like I know what they're spending.
Yeah.
They're going to be giving a large inheritance. It's like to me, unless I die first. So it's like, and my sister, but they don't want to see the volatility in the market, and because of that, they're locking in CDs. Is that going to be the longest, like highest rate of return over 20, 30 years?
Right.
No.
Right.
But if we're looking at the city employee pension fund having a defined life of just basically the beneficiaries, maybe it's like we want to see the volatility. And these are questions where it's like you could change. Like I know it's like one of the other council members said it's like why aren't we more aggressive? It's like
Sure.
And I don't think there's a right or wrong answer. It's just in terms of what you feel comfortable with in terms of it's like how you want to go about it. So
And I mean, I'm madly scrambling for what I read about I mean, this is, in a way, it's hard to talk about, but somewhere in here, it gives the ages of our beneficiaries.
right, exactly.
I don't
Actually,
think
it's-
30 years is very realistic
Correct.
for this pension.
Right.
Just if you look at
Right,
that, the
right.
actuarials,
Oh, yeah.
and
Yeah.
but we never know.
Right.
So,
Last page.
is it the last page? I know it was in here. I read it somewhere.
And that's where this
And-
concept of generational wealth, where it's
Right.
like, this is not
Right.
necessarily going to be benefiting the current beneficiaries, it's what's going to be passed along, it's like, to wherever the funds go.
Well, and I
So-
think we're as much a steward of that money as we are
Yep.
what our beneficiaries are owed.
Absolutely.
So I want to make sure that we are being as cautious as possible because we have no idea what's going to happen
For
in this
them.
market.
Mm-mm.
And, you know, that's a good chunk of change that we've got. And I don't want to just proverbially throw it away.
Right.
You know, so I don't know what our options are necessarily, but I'm feeling pretty conservative right now.
Yeah.
I'd say the whole world is feeling pretty
The
conservative
whole world.
right now. Everybody's riskiness has been tested.
If
Yes,
you
ma'am.
have any private, personal investments, you don't open those envelopes anymore.
That's right.
Right, exactly. Yeah.
Because it
If you
looks the
don't have
same
to.
way as this does.
Right.
Sure.
Yes, there's really no escaping
That's
the
right.
situation. So,
Right. So,
I think if those funds were moved over, how would they immediately be invested? And I would say it's like that they would be immediately invested in sort of a similar overall structure, 60% equities, 40% bonds. So it is, from one perspective, it's basically just having a strategy consistent with what would be the long-term horizon, as opposed to being more conservative. From our perspective, we're fine with whatever you feel comfortable with. So in terms of, this is a like philosophical kind of like thought process. It's like, what would you like to do in terms of?
Would we have any negative implications of going one way and then coming back in a couple of years if the market gets better? Like, would we see, I mean, are there any big penalties or anything like that?
Not penalties, it's just opportunity costs.
Okay.
In terms of, generally, it's like when people are making these decisions, it's generally at the bottom of the market where it's like the greatest amount of fear exists.
Yeah.
And it's just the general adage of selling low and then buying high. So everyone feels extremely exuberant. It's like at the start of the year, it's like, we've already experienced 20% returns. It's like, let's keep going. It's like, and you just don't see any type of pearls. And it's like, and it affects everyone. So in terms of, it's like, I rolled over my 401k to a different provider, and it's like, let's keep the same strategy. Don't do anything different. So 100% in equities. But because it's like, part of it is like just emotional in terms of you feel good about the economy. Now with, it's like prices are depressed, it's like, okay, how much lower can you go? And that's where it's like, you have the safety net set aside with the liability to fees portfolio, where all these variations is not going to impact who this pension fund is going to benefit. So it's like, it's all noise from the perspective of the pension. And that's the reason why we structure the portfolio that way. So.
And we're very fortunate that it is, as you said, as good as it is.
Yeah.
And I think one of the best things that this board has done is to give benefit to the beneficiaries.
Yes.
You know, with the 5% increase, and because we know we can do that.
Right.
And that's a really good thing.
Yeah.
Because I think a lot of people who are on pensions don't get that.
Right.
So,
the extra bumps as well as
the extra bumps.
as well as the cost of living adjustments. It's like,
Yep.
it's
So
like,
good for us.
yeah. My grandmother gets a pension from working at like a textile factory during the war, and it's like, it's a $3.57 per month for the last 20 years. It's like, they make it easy for taxes because it's like, I do her taxes. It's like, it's like, okay, $657.20. It's like, don't even need to get the 1099 because it's the same amount for the last 15 years. So in terms of, it's like, you have the COLA increases, and I think during the time that we've been managing, there's been actually 2 bumps, one-time bumps. So, and try and find a way to sort of share the excess with
Yes.
Okay. I'm sorry, I didn't mean to derail.
Other
this.
questions?
Conversations, because, you know, we don't have the luxury of a very long, you know, a huge
Right.
amount of time to
Right.
try to.
Yeah, and it's a great discussion. It's like, in terms of, it's like, I think one of the things when it's like, when you have some people having one feeling and others on the others, it's like, maybe this is the happy medium. So it's like, but in terms of, this is a market that's been really testing. So.
Sure. And as we mentioned, it is comparable to what we're seeing in our other investments. Yeah.
Except for the amount of drop in the other one. It's a way bigger pension.
When the pot's bigger,
So-
it feels bigger.
So
So it might be
it's like, oh my
relatively the
gosh.
same.
Yes.
Right.
Yeah.
Okay. Do you want to go ahead
Sure.
and proceed?
Yeah. So in terms of going back now to tab number 2, so other direction.
Market update?
Yes, market update.
Page, which page are you on?
Let's go 8.
7,
Yeah,
8?
section, yeah.
I can't pick it.
Okay.
Sorry about flipping around.
Sure, look at that CPI.
Okay, so in here.
The stunning one is the CPI.
Yes.
Holy moly.
Yes, so In terms of consumer price index is a gauge of inflation. And inflation is now at the highest levels going back to the late 70s, early 80s. In terms of, as of September 2022, it was 8.2%. And if you want to put a date on your calendar to watch, the markets are all focused on CPI. So if you want to see some volatility in the market, put the CPI index on your calendar, and it will either go up or down that day. And it's and if you think back on Thursday, the CPI report was released at 8:30. It came in better than expected, and what better than expected means is that it was lower than what the markets anticipated. And what do we get? It was like a 3% increase in the stock market, and that carried forward into Friday as well, when on Veterans Day. And then it's like we're seeing a nice, strong return today as well. It's like the Federal Reserve doesn't want to have too many people getting too antsy that this is going to be. It's like what is going to occur, but in terms of once we start seeing inflation come down, the Federal Reserve is going to be less hawkish, meaning that they're not going to raise rates as aggressively, and the markets are going to feel much more comforted. So, when is CPI going to come down? That is the $1 million question, and it's going to drive the markets going forward. The thing about inflation is that it's a comparison compared to last year. So just because you may have been paying $100 for electricity, and now you're paying $140, so that's a 40% increase. Next year, if you pay $140 again, inflation is actually zero from from last year to this year, because prices didn't increase year over year. Now, compared to 2 years ago, you're still paying quite a bit more. But in terms of what the Federal Reserve is looking at is what happened just the last year. So as soon as those prices kind of decelerate, it's going to actually be a signal to the Federal Reserve that they're not going to have to be as vigilant. Everyone's experiencing inflation in terms of gas prices. They aren't as high as in the summer, but they are definitely higher than they were 12 months ago. Going into the winter, I'm a little nervous about natural gas prices. I think Kentucky is not all natural gas. Some people use natural gas, but natural gas prices are much higher than they were last year. Of course, food prices. It's everyone is saying, okay, I went to the grocery store, and instead of being able to buy 10 bags of groceries, I'm getting 8 bags of groceries. When you hear it from everyone that you talk to on a casual conversation, you could know that inflation is rampant throughout the economy. And that is what the Federal Reserve is trying to kind of combat, because as you can see on the next slide, Jerome Powell and others basically say if there is rampant inflation, the economy just doesn't work. It causes too much volatility, because if you're seeing high amounts of inflation, what's going to happen? Employees are going to ask for higher wages. When they ask for more higher wages, that's going to cause basically a circular effect where more prices are going to have to increase, because it just kind of runs rampant and becomes entrenched into the economy. Part of the reason why there isn't a sound answer is that on the bottom of slide 9, the shaded area shows the estimates by economists on what they think the yield on the 2-year Treasury note is going to be, as well as the 10-year Treasury note. If you look at the shaded area, it's all over the place. In terms of, some economists think that rates could go down to 2%, or they could be as high as 5% for some long period of time, which basically means your guess is probably just as good as someone spending 40 hours a week looking at all the economic data. No one really knows, because there are just too many variables in terms of, is OPEC going to cut back supply and cause oil prices to remain elevated? Is the United States going to implement a policy of not exporting semiconductors, which causes prices to rise as well all across the globe? So the Federal Reserve, in order to try to combat inflation, they've been on an aggressive tear in terms of they've been raising rates quite aggressively. Yeah. They raised rates by 75 basis points just at the last meeting. In terms of the new rate is in the range of 3.75 4, so 3.75% to 4%. We started the year at 0 to 25 basis points. So just an extremely sharp increase. If you have cash lying around, it's a great opportunity to start looking at CDs and other type of investment vehicles because things are changing so quickly. It's it's just startling. And I think the banks are hard to keep up with these remarkable increases.
The CD rates are going
Right. Yeah.
way up.
Yeah.
I wanted to ask you back on when did you say the
This past-
inflation year is the highest it's been since, was it the 70s or the 80s?
I think 82.
82.
Yeah, that's right.
Okay.
So,
Decades ago.
yeah.
Well, that's...
40 years ago.
Yeah, 40 years.
Yeah.
Well, because Clay, you're probably Clay's.
Ready to turn 40.
My son and Whitney.
Yeah.
We're just barely born then.
Right. And also to put into, when we were talking about returns, this first half was the worst in 50 years. So in terms of when you're thinking about, are you going to have a similar situation? It's probably not. It's this was the worst first half in over 50 years. And that was because all the asset classes were correlated in terms of what you would normally see is that, okay, if the stock market decreased, bond prices increase. And it's kind of a natural hedge. This year, everything went together. And there is no benefit of diversification, where it's going into international equities. Now you might have had immediate returns. Everything was kind of lockstep.
So the last time that happened was 50-ish years ago?
Yes,
How long did that last?
just a year.
Just a year.
Yeah.
Okay.
This is all part of the challenges we've
I
got
know.
right
Yeah.
now in history.
Right.
Right, exactly. So
We're in good company, though.
We are,
Yeah.
yes.
the problem is you can't turn, there's not many people in the profession that could kind of recall. It's oh yeah, it's this is what Paul Volcker did. It's
right.
I reached out to a couple of people that have a lot more gray hair than I do, and it's oh yeah, it's this is what happened. It's but then it's trying to get everyone else on board with, okay, how is the economy different? They're trying to say it's oh, we're a different type of economy. We're not as oil-based. And it's in terms of, but it's kind of playing out similarly in terms of, okay, we can't have 8% inflation. Plain and simple. It's
Even though we do.
It's staying 8%.
Okay.
So yeah, the September number was 8.2. The October number brought it down to 7.7 year over year. So going to 11, it's we already talked about the S&P 500 index declining by 23.9% and the various other global indices. So what is the Federal Reserve wanting to do and trying to do? It's you would think, it's okay, the Federal Reserve's out there to help promote growth, it's make the economy run smoothly. No, right now, the Federal Reserve is trying to actually slow down the economy in order to get inflation under control. So they're trying to basically have people get laid off. It's not a typical situation for the Federal Reserve because what their mandate is full employment. But because we have such a robust employment labor market, there can be job losses, and it's going to be absorbed by the rest of the economy because there's so many employers looking for employees. So we're looking at basically positively cheering indices like the ISM Manufacturing Index, which we're seeing deceleration. So any number above 50 represents that there's still expansion in the manufacturing sector. However, you could see it's much slower than it was just 12 and 24 months ago. Another area where basically things have just stopped is the housing market. You've probably heard at the beginning of the year where it's a house goes on sale. Before Sunday, you've got 7 bids and probably 30 showings. And those bids were 5-10% over asking, even more. That's not happening now. And all of a sudden, it's just overnight, it's disappearing. The reason why is that at the beginning of the year, mortgage rates were in the 3% range, 3.25%, 3.5%. It's like we've seen some improvement just this past week because yields have come down because of the CPI index. But last week, mortgage prices were at 7%. So what does that mean? Are you going to be inclined to upgrade your house where it's like you've locked in at 3% mortgage rate and buy a bigger house at 7% mortgage rate? No, because it's like the extra monthly P&I payments is going to be just tremendous. In fact, if you bought the same price house at the beginning of the year compared to now, it's going to cost you 25% more in terms of the actual payments because of how much interest rates have gone up. So it's going to make housing less affordable. Now, at the end of the day, it's like because prices of the homes are declining, it actually causes inflation to come down, but it doesn't make them more affordable. So we're seeing this kind of like spillover, and it's like if there's higher mortgage costs, construction builders are probably going to like pull back. They're not going to be developing as many new neighborhoods. They're probably going to continue to do some, but in terms of they're probably not going to be as aggressive as before, because it's like if that house gets constructed and they have to sit on it, it's costing them money. So they're probably going to just take a slower pace of putting in new homes. And then one way you look at these charts, like, okay, things are better than they were over the summer, but prices are much higher. And as I already alluded to, on the bottom right-hand corner, natural gas prices are up 81% year to date. So you don't use much natural gas during the summer, it's like, but the winter, it's like, yeah, you definitely do. So it's like, I'm preparing myself on what those bills might look like. And just lastly, it's like the U.S. economy continues to show tremendous strength in the labor market. The unemployment rate as of September was 3.5%. On the next slide, you would see that 6.7 million new jobs were created in 2021. 3.8 million new jobs were created through September. We also saw another very positive October report. So we've created about 4 million new jobs in year-to-date in 2022. And there's no sign of the labor market becoming weaker. In terms of the chart on the left-hand side, the blue line shows the number of job openings. The red line shows the number of unemployed people. There's basically 2 jobs available for everyone that's unemployed, which means like it's a workers' market these days in terms of being able to find a job and being able to just kind of call it quits and then go to another place of employment pretty quickly.
And isn't this, in all the discussion about recession, isn't this an aberration?
Yes. Yeah.
The unemployment rate and the jobs.
Yeah.
I guess I don't understand. It doesn't fit a standard profile, does it?
Exactly. So in fact, it's like everyone prior to this year, it's like the sort of the implicit definition of a recession was basically 2 quarters of negative GDP growth. We actually have experienced 2 quarters of negative GDP growth earlier this year during the first quarter and the second quarter. And then everyone basically says, like, how can we have a recession and we have a 3.5% unemployment rate? So then they kind of go back and say, okay, the actual technical definition of a recession actually comes from the Bureau of Labor Statistics, and they declare the recessions and when they happen. But what I just generally find is that they declare them about 12 months after a recession has occurred.
So everybody else knows it already.
Right, exactly.
Before they declare.
Right. Which is part of the reason why it's like we saw some of the stock market decline. It's like, okay, if you have the Federal Reserve aggressively raising rates with the goal of slowing down the economy, how much slower is it going to occur? So in terms of, there's been a lot of rate increases. The Federal Reserve has already said it takes 12 months for one of their Fed increases to actually fully impact the economy. The first increase only occurred in March. So we haven't even seen the full effect of the March increase, nonetheless the additional several increases since then. So,
And aren't we expecting another in December?
yes, yeah. And it's already baked in terms of the thing about the fixed income markets is that they anticipate what the Federal Reserve is going to do even before the Federal Reserve even starts talking about it. So the markets are already anticipating a 50 basis point increase with about 50% probability or a 75 basis point increase. So that's where the market's at. And in terms of some kind of say, it's like, okay, if the Federal Reserve kind of like lets up on the gas, then they might kind of foretell to the market that they're slowing down. So they might just go with the 75 basis point increase to follow the existing path. And then on top of that, there's a meeting in February where there's another 25 basis point increase already baked into the market. So that's where it's like when you're looking at the chart on the next page, it's like this data was as of September 30th, but 2-year treasuries were up to 4.80 after the hot October report that we saw.
You know, do you ever recommend, I'm going back to the way beginning when nothing looked good.
Okay.
Do you ever recommend that a pension like this put money into a short-term CD, like a 1 year? Or
in terms of we can.
you have to take it out of something else, but...
Right, exactly. In terms of corporates are similar to CDs in nature, so in terms of we definitely can do that. So in terms of as part of a risk mitigating strategy, so.
Just a curiosity question.
Yeah.
I was thinking the same thing.
I mean, right now, if I remember, I get an alert on CDs right
Yeah.
now, and if I remember at least one place, the 1 year is 4-point-something% interest.
Yeah,
That's pretty,
yeah.
but you take it out of one thing, put it there for a year, and then, I don't know.
No, these are,
Just-
yeah.
I don't know that we do that traditionally.
Not traditionally, because in
Right.
terms of like the general paradigm is that your pension funds are generally underfunded. So in terms of, and with the actuary assumptions, it's like this is within the footnotes, is that an actuary, like in order to determine the actuary AAL, they have a underlying assumption of what the rate of return is going to be. And you can see, and this is a third party, it's not from PFM's perspective, that assumption is 7%. So whenever you're investing in obligations lower than that assumption, you're going to actually create a wider gap, just generally. So doesn't mean that you need to find a opportunity to get more than 7%, but in terms of, it's like, that gap's going to widen. So instead of us being 508% funded, like, okay, maybe next year we're at 480%. At the end of the day, we have more than an ample amount of money for the beneficiaries. And that's where it's like, it's a completely different story versus like the police pension fund. And it's like,
Yes.
you're in a unique position. It's like your options are much more wider and flexible. So,
Okay. Anything else?
no. It's like, is there other discussions?
Any other questions for David?
I don't have a question. And I apologize for the timing of this conversation because it sounds like it's related to the report, which it is not remotely. But one of the things I was asked to bring back was the last time that we went out for bid for investment services. And our 2014, we're still operating on the 2014 agreement. And so that would be a question if the board wants to engage in the RFP process. Again, I think we're well within the time frame to do so.
Aaron, what is best practice?
I think we typically do our agreements, if I'm not mistaken, 3 years with option to renew for an additional 2-year periods. So we're probably on the outside of that. But COVID
Right.
It turned
COVID.
into-
It's all COVID.
It did throw off some timelines on some things. So I think it's
Yes.
probably best practice to at least go out for bid and have that conversation. Again, I think you're exactly right. We're not unique to the market and what's happening out there. So it is definitely not commentary on the services we are
Right.
receiving, but I do think it is time that we do that since we're post-COVID and back into the swing of things.
Next, so we'll soon be 10 years out
Yes.
in a couple of
We're knocking on that door.
What's the timeline on RFP process for this?
We would probably initiate it through central purchasing. We've got obviously previous RFPs that we've done, so it doesn't take as long as starting from scratch on something like that. We could probably have one prepared for review by the board at our next meeting, since we meet quarterly.
Well, I mean, I think as we are trying to be good stewards of the money, we need to do our due diligence and make sure that we're.
It'll have to go to council.
Yes.
Yeah,
Yes,
approval of the to put the RFP out and then accept it, or no? I can't remember
If I'm not mistaken, I think it goes when we make a recommendation.
The recommendation.
But I will double check on that.
Is that what you think, Michael?
Okay.
Okay. Michael keeps us straight.
He does.
I think that's a really good idea. What's everybody else think? You've already, yes, yeah.
And I don't know if we would need a board action to do that, Michael.
Maybe a motion. Do we need a motion to ask central purchasing to?
I don't think you would need board action to initiate it.
Okay.
But when you have a actual draft RFP in front of you, you might want to make a motion to proceed with the RFP.
Okay.
Okay.
All right. Can you talk
Yes, ma'am.
to Todd in central purchasing?
I can.
All right. Thank you very much, David, for your report. And
Can I just ask, is the police and fire pension?
I think they're probably pretty close to the same
Right.
time frame,
Right, yeah.
if I'm not mistaken.
Right, that's right.
We also have actuarial services that get bid for them, as well as the
Yeah.
experienced it.
Because I thought the police and fire pension fund was actually put out
Before.
there before ours, so, yeah.
We may do both at the
Oh,
same time. Yeah.
that's the one where we look at the numbers and we go, oh my gosh.
Yeah.
Because of course, the bigger the pension, the more it's been
Right.
dropping.
Right.
That's okay. It will come back.
Long-term perspective.
And kind of, if I could insert one thing here that's related, is now that certain things are over, I'm going to put together the small group that's going to look at, you remember the conversation we had about what we do with, right now, when this pension closes, what's left in the pension by law will go to the police and fire pension not as a regular contribution, but it will just go into the pension. And so what this board asked is that we get a small group of people to look at that, including police. Lieutenant Kennard was part of that conversation, and to see whether there's some sort of a compromise position that we could ask the state legislature to change that law for us. So I'm getting ready to put that small group together and see what we can come up with. So, and then that would have to go to the legislature. So, okay, do we think number 5 is finished? Everybody got their questions answered? Thank you very much, David. Appreciate it. And Samantha?
It is short and
Elections.
simple, yes. As you all know, we passed the code changes to the election process at the earlier meeting. It had some new guidelines confirming nominations if they were made by members other than themselves. The timelines in the ordinance were pretty gracious, so we've shortened them in our own office for our own processes. So on September 30th, I mailed out the nomination forms to 11 retirees. I got 3 back. We had a total of 5 nominations. 3 were valid after confirmation. On November 9th, which is last week, I sent the secret ballots back, and as of this morning, I've gotten 3 back. So
Okay.
they have a deadline of December to return.
Okay.
And we tell them that it needs to be postmarked by December 1st.
Okay.
So hopefully we'll get a few more back.
Okay, so we'll have a report at our next, when is our next meeting?
January
Oh,
31st.
Let's see, 31st, okay. So we'll have a report back by
Yep.
then.
Yep.
Great. Any questions?
So we're good to just accept however many ballots come back, right? We don't have to have a minimum amount of ballots returned. Okay.
No, when the secret ballots go out, they have whatever number. At this point, it's fairly small. And then we just go with what we get.
Okay, very good. Any questions?
I just have a quick procedural question. We did get the valuation report. Is that going to be presented to the board, or is that for informational purposes only?
I'm sorry,
The
what was it?
actuarial report, does that typically get presented?
When I asked Susan about it before, she said it did not.
Okay.
For information?
Yeah.
Okay. Did you have a question?
I was just going to ask,
Sorry.
do we know how many people are left on the list, employees and beneficiaries? How many are we now?
In the total pension, 37, isn't it?
It was, yeah, somewhere around
Or-
30.
Did that include,
It's in the actuary report.
I think we were
2.
37 and we.
and then
lost
we've
two. Yeah.
lost 2, so it's 35. Yeah.
This is June report.
Okay. And those, if you have your valuation report on that last page, I don't know if you all have it with you, is that chart with the retired members, the survivor benefits, and the totals, and it shows the numbers of retirees, for example, and their age groups.
Yes, ma'am.
And then it has the survivor beneficiaries and their age groups.
It came separate from the board packet today.
Mhm.
It was a separate email.
If you want, after the meeting, to come back to the office, I can run it for you. If you'd like to have it on
That'd be
hand.
great, if you want that.
What you sent me to home, that was in that?
It was sent, this came out last week. I think it was sent separately from the
The 8th.
packet.
I know I got a packet at home. I forgot to bring it.
Yeah, I'm happy to, she can make a copy. Okay, thank you.
Thank you.
Would you like a copy of it?
Okay. All right, very good. All right, anything else? All right, could I have a motion to adjourn? All right. And we got a motion and a second. All those in favor say aye. We are adjourned, and I really appreciate your dedication. With the new council members coming on, we'll have some new city employee pension fund members to join you.